What's up, guys? It's your boy Farad Killer here, and today I want to talk about the so-called native bond market in the crypto world. Yeah, that's right, bonds. The boring financial instrument that some people believe is only for grandpas and pensioners. But hold on, my friends, because the reality is that the crypto bond market is not developing as expected, and there are some reasons why. Let me break down for you. First of all, the supply side is not favorable for long-term risk investors. In traditional finance, bond investors generally have a lower risk appetite than stock investors. They aim to achieve stable returns by taking relatively low risks. However, in the crypto market, we have seen extreme volatility due to Bitcoin's 4-year halving and the industry's rapid growth and contraction. As a result, about 90% of traders lose money and leave the market. Maybe that's why we see perpetual contracts and other short-term leverage instruments more popular than long-duration bonds. Secondly, the demand side is also weak. Institutions and DAO Treasuries were once thought to be the main drivers of the crypto bond market, but recent events have shattered their narratives. Institutional investors suffered the significant losses after the Luna and FTX collapse in 2022, which not only affected their current capital usage but also caused regulatory agencies to pay more attention to the crypto industry. Meanwhile, DAO Treasuries mostly consist of their own tokens, and it is uncertain whether they will hold enough other assets in the future. In short, the crypto bond market has yet to find its footing. Don't get me wrong, I love the innovation and creativity of the crypto world, but we need to be realistic about what works and what doesn't. So my advice to you is to be careful when investing in bonds in the crypto world and always do your own research. Peace out, guys. So next, let's talk about some exciting news in the DeFi space. The Ethereum Foundation has approved EIP 3475, a new API standard proposal from DBond, a decentralized bond platform. ERC 3475 is a game changer that will enable the creation of tokenized bonds with abstract on-chain metadata storage. This means that every bond category ID represents a new configurable token type, allowing the issuance of bonds with multiple redemption data. DeFi has been lacking a standardized solution for issuing complex interest-bearing bonds. ERC-20, the most widely used token standard, cannot handle the variety of bond types and requires each bond to have a separate smart contract. This is where ERC 3475 comes in. It has complex data structures which will enable developers to create more complex logic for redemption and repayment mechanisms, filling the gap in DeFi's fixed income market. So ERC 3475 is a significant upgrade to ERC 20, offering more flexibility in creating and managing multiple redeemable bonds. With ERC 3475, DeFi users can customize and issue decentralized bonds with complex structures, including features, options, warrants, swaps, and more. This new API standard will be a catalyst for the growth of DeFi's bond market, expanding offerings beyond the traditional savings, lending, asset management, exchange, derivatives, insurance, and funds. Well, based on benchmark interest rates, POS yields on public chains might be the best choice. This yield level is based on a larger ecosystem with less volatility in business development than a single app project. Additionally, this yield anchors the growth of the ecosystem and is more easily accepted by participants on the chain. For public chains, users need to purchase public chain tokens to pay for substantial activities on the chain and pay for substantial activities. The decentralization of public chain tokens may be greater, moreover, under the influence of the Fed protocol theory. Many investors tend to buy public chain tokens to earn beta returns. So therefore, the POS yield is not subject to the prolonged influence of a single DApp project and is more stable. So in terms of the audience, bond market participants are more suited to high-risk speculators and low-risk arbitrageurs. The crypto market currently lacks long-term investors, making it difficult to find a large number of stable investors. Furthermore, the volatility of interest rates still needs another counterparty to bear the risk. So a high-risk participant who speculates on interest rate fluctuations is required. Although institutional and DAO funding sources are lacking, there are many arbitrage traders in the market who can act as a source of low-risk investment. At the same time, there are more high-risk speculative traders in the market who can absorb volatility on the other end. For example, projects such as Pando Finance, based on LSD derivatives, split LSD's yield into two parts, the principal token and the yield token, which you can also regard as a zero coupon bond and the floating rate bond, allowing arbitrageurs and low-risk investors to meet the yield requirements and allowing high-risk investors to participate in the prediction and the speculation of LSD yields. From the perspective of the term, the crypto market's overall cycle is very fast, so bond maturities should be shorter, such as bonds with a term of less than 1 year. This design not only benefits low-risk arbitrage traders, but also benefits high-risk traders. Short-term interest rate fluctuations will be more severe and frequent, providing more potential trading opportunities for short-term traders. So there you have it, folks. My predictions for the future of the crypto bond market. As always, I'm Fat Rat Killer, and I'll see you all next time. Thank you.